This is Boom Bust, and these are the stories that we're tracking for you today. First up, European banks are playing it fast and loose when it comes to dodging new capital requirements here in the U.S. I'll tell you all about it coming right up. Then we have political economist Yanis Varoufakis live on today's show. At least we hope so. We're still working that out. He's telling us what he thinks is next for the Eurozone. And in today's Big Deal, Ed Harrison and I take a look at what's going on in Europe's most western country, Portugal, that is. You won't want to miss it, and it all starts right now. For years now, European banks have run operations on much thinner capital requirements than their American counterparts. And with new U.S. financial regulatory rules set to kick in as early as next year, European banks are now looking for ways to skirt the new laws. Banks, including Barclays in the UK, Deutsche Bank of Germany, and UBS of Switzerland, are all allegedly considering tactics to shore up U.S. subsidiaries by buying the subsidiaries' debt. Other banks are considering selling assets or moving firms into legal structures outside the purview of the U.S., aka offshore. Now, according to the Wall Street Journal, U.S. bank entities would, quote, issue their parent companies a type of bond that converts into equity if the U.S. business capital falls below a certain level. Some European regulators have allowed this type of convertible bond to count as capital, although it is regarded as less helpful for absorbing losses than simple equity. And the European parent companies would finance the purchases of the subsidiaries' debt by issuing bonds to investors. I mean, why use your own principal when you're trying to skirt capital laws in the first place? No, why not just raise more debt? Seems safe, right? Anyway, one thing is for sure, those European bankers, they ain't afraid of some debt, and they sure aren't afraid of some regulations for that matter either. Now, on today's show, we're discussing Europe. And our next guest, Yanis Shedlock, writes a widely read blog called Misha's Global Economic Trends Analysis, in which he looks at all the important global macro issues facing society today, including Europe, of course. Now, I spoke to him earlier about Europe, and I noted that data coming out of Europe seemed to indicate a recovery. So I asked him, is Europe in a recovery? Here's what he had to say.
How can Europe be in a recovery? Just look at France. France is the weak link here by a long shot, and arguably Spain is bottoming. Perhaps one can look at the current account in Greece, which is a very minor country, and perhaps it's bottoming. But when you look at France, when you look at the Netherlands, when you look at some of the larger countries, France is really a basket case here, and unemployment is rising about every month. There are huge disputes. Everyone's unhappy with Hollande, and so one wonders, how long can Germany keep pulling all of Europe together? I don't think they can.
Okay, now Europe has been forced to undergo austerity in the periphery to prevent default, as you said, especially in Greece, but now bond yields, they're dropping. Is the Eurozone crisis over? It's kind of like my first question, but Eurozone as a whole, I'm asking.
Well, actually, bond yields have been dropping, not just in Europe, but in the United States until recently, actually, because of central bank manipulations of buying bonds in the United States and in Europe of a belief that everything's under control. And if you look at the leverage of banks, well, who's buying these things? We got an enormous problem in Europe where all of this debt is owned by, the Spanish debt's owned by banks in Spain. So what happens if yields start to rise there? And I think they're going to as soon as we have some sort of contagion crisis. It's starting right now in emerging markets. I think it's going to spread. Greece is making overtures here about defaulting on debt. Certainly, the Scissor Party, the leader, has come out and said if they win the election, and right now they're leading in the polls, they wouldn't pay this debt back. So how does all of this work? I don't think it does. And then if you look back at France, some of the things that are happening in France, like Spanish real estate companies are moving into France, and France is complaining that these guys are undercutting them on construction costs by as much as 40%. So Spain's all up in arms there. What they really need, actually, in France especially, is prices to go down so that France could be more competitive. But the central banks are resisting this, and in the process of resisting this, especially in the United States, they've added liquidity that in the United States has fueled property bubbles, bond bubbles. You have a bond market bubble in Europe as well, with all the leverage of banks holding all the European debt. Mathematically, it doesn't work. What can't be paid back won't. We're just waiting for a trigger for a crisis here in Europe. I think and the trigger might very well be emerging markets.
Now, last week, official figures, they showed that the Eurozone inflation fell to 0.7% in January. That's further below the ECB's 2% target. Now, monetarists would say that the ECB needs to employ quantitative easing to fix this. What do you think of the ECB potentially employing QE?
I think they're likely to, as long as Germany and the Bundesbank doesn't complain. But is that the right policy? Let's start with a simple question. Why are falling prices bad? It's certainly what we need here in the United States. Look at the minimum wage debate. Maybe we can touch on that later. But, everyone wants minimum wages to go up because prices have gone up. So what do consumers want? Consumers want prices to go down. It's central banks that want prices to go up. And why shouldn't they? Here's the claim here. All these economists claim that if prices fall, that people won't buy things. Well, that's nuts. Look at the price of computers, of flat screen panels, of TVs, all the electronics. Prices have been falling for years. 5-6 years ago, it might cost $15,000 for a huge 60-inch flat screen TV. You can buy one today for $600 maybe. So, what is with this notion that falling prices are this horrendous thing? It's a good thing. They should welcome it. France in particular desperately needs falling prices. What central banks don't realize is by inflating money, by supporting these bonds, they've actually created bubbles. Look at the U.S. equity market. Actually, the equity markets worldwide have soared. And so we've created this bubble, and they've rebuilt the housing bubble, reblown the housing bubble in the United States. Well, loans are made on the value of those assets. The deflation they ought to be worried about isn't price deflation, but asset deflation. And it's asset deflation. The Fed and the central banks can print money all they want. And the Fed certainly wanted it to go into jobs. The Fed wanted it to go into jobs, wanted to go into hiring, wanted to go into loans. It didn't go into hiring. It didn't go into loans. It didn't go into jobs. It went into stock market bubbles. It went into bond market bubbles, corporate bond market bubbles. It went into the prices of assets. Close to 50% of the homes bought in the United States in the month of November and December were all cash buyouts, squeezing up prices. Now, what happens when these prices start turning down? It's asset bubble deflation that's going to cause the real problem, not consumer prices where everyone's screaming for lower prices. The Fed and the central banks just don't get it. They've spawned these bubbles that are going to pop, and it's the popping of those bubbles that it's the deflation that they really don't want. Instead, they're worried about the wrong deflation, if you would. Actually, if you think of it in terms of money supply, the advance of of credit and money is really what is inflation. But if you look at what central banks are actually worried about, it's falling prices. They should be welcoming falling prices.
That was investment manager and financial blogger Mike Shedlock. Time now for a very quick break, but stay tuned because coming up, Yanis Varoufakis talks about the so-called European recovery. You won't want to miss the interview I have with him. Then Ed Harris and I are taking a look at the Portuguese housing market. Is recovery on the horizon for the beleaguered nation? We'll let you know. But as we head to a quick break, here's a look at some of today's closing numbers at the bell. Stay tuned.
Patients are force-fed.
Two explosions near the finish line of the Boston Marathon.
More than 1,000 people have gathered.
What is the latest that you're hearing about the number of victims?
Everyone is saying that Europe is in a recovery. Manufacturing data has been positive and GDP data as well. Bond yields in Spain are at record lows and foreign investors are coming back into Portugal, Spain and Greece. However, if one looks at the jobs data, it's another story altogether. Unemployment in the Eurozone is still 12.1%, that's a record high, and youth unemployment is twice as high at 24.2%. So the question is Europe in a recovery or not? Yanis Varoufakis, a professor of economics at the University of Texas at Austin, and an expert on European sovereign debt and the European sovereign debt crisis, is here to discuss. Now, Yanis, last time we spoke, it was back in January. Seems like so long ago, but only a couple weeks ago. And you were very pessimistic about the Eurozone. Since that time, we've seen a lot of figures pointing to growth both in the Eurozone as a whole and Greece specifically, which you know quite a bit about. Now, are you more optimistic as a result of these figures coming out, or are you staying the same, still pessimism?
If you look at the figures, you will realize that what is going on in Europe is a triumph of wishful thinking over reality. What are the growth numbers exactly? The whole of the Eurozone is stuck in a rut. We have absolutely no genuine growth overall in aggregate. There is a smidgen of a modicum of growth in Germany, but nevertheless, it's extremely low by world standards, and in view of the depths to which production had fallen in the last 5 years, we're talking about what we might sort of sarcastically refer to as the dead cat's bounce. Whereas in the rest of the Eurozone, what we have, since we're talking about figures, in the last month we had confirmation that industrial production actually fell. The numbers seem to be completely at odds with the exuberant rhetoric that's coming out of Europe.
Now, but things, they seem to have died down in Europe. Regardless, I know what you're saying, I hear you, but according to Twitter, at least, you don't hear the same chatter about the crisis and the Eurozone breakup. Now, you're more likely to hear stuff about the UK going into a breakup. What's going on there over in the UK?
Well, what's going on in the United Kingdom is you have a resurgence of a very sensible kind of Scottish nationalism in the face of a very serious decoupling between England on the one hand and Scotland on the other. England is increasingly being absorbed by the logic of perpetual austerity for the masses and socialism for the bankers and for the selected few. You have a kind of a new form of Euroscepticism. There's going to be a referendum which very likely is going to push England, or the whole of Britain if it remains unified, out of the European Union. Whereas north of the border, north of Hadrian's Wall, you have the majority of the Scots who are very seriously questioning the logic of perpetual austerity, who are completely and utterly committed to staying within the European Union, and who are not taken over by the frenzy of xenophobia, which is so evident south of the border, especially with the rise of UKIP and the general attitude towards the so-called of invasion of the British Isles by foreigners, Romanians, Bulgarians, and so on.
Okay, now I'm glad that you kind of bring up Greece, because in Greece, retail sales are up, car sales are up, industrial production is up, and Greek yields, they're down. The question is the Greek economy going to start growing?
I hope it does, but at the moment the government is celebrating the fact that the recession, the never-ending recession, has not ended, but it has slowed down. So the good news is not that we have stabilized the economy, but the rate of diminution of shrinkage is falling. You mentioned the rise in car sales. Well, that's only a rise if you compare it to January of 2013, when there was a complete and utter collapse. I mean, car sales went down to zero, effectively. And now what has happened is there's been a 15% bounce relative to last January. If you look at the annual figures, you have a catastrophe. If you were a car dealer in Greece, you would have absolutely no cause to celebrate. Speaking of industrial production, it hasn't gone up, it has gone down. Retail sales have more or less stabilized, but what? At a very catastrophic level. It's like saying that the United States economy in 1933 stabilized. Well, it stabilized, but at a very, very, very low level.
Right.
And if you look at investment data, because remember, investment is what drives future growth, or even short-term growth, investment is down. And even the government is predicting that investment is going to fall further.
Now, when you look at the Eurozone numbers, one country that stands out on the negative side is France. What do you think is going on there?
Well, France is the battlefield for the euro. Because, let's face it, the whole of the European Union, and in particular the Eurozone, is predicated upon the Franco-German axis. France was always the weak link of that axis. If we go back to the 1990s with the exchange rate mechanism, the ERM, France's incapacity to stay bonded to the German economy was the reason why that early attempt at monetary union failed. So if there is a breakup of the euro, it will proceed beginning from the periphery, and it will reach its climax when France is effectively jettisoned by Germany. So what we now have in France is we have, if you want, the manifestation of the tectonic plates shifting underneath the Eurozone, causing incredible tension and bringing the Eurozone, while the bond markets have stabilized and all the numbers seems to be doing reasonably well, nevertheless, underneath the surface, you have a decoupling between the German and the French economies. And you can see that now France is caught in a situation where you have absolutely no degrees of freedom that will allow France to regain the poise which is necessary in order to retain that link with the Deutschmark. And the French government is completely, utterly out of levers. They have no access to monetary policy. They are on a buffer with fiscal policy, and they are stuck in a currency union where the euro is at a very high level at the moment, in a world environment in which other currencies are diminishing in value. And the big question is, will the French political elites find it in themselves, whatever is necessary in order to counter the Merkel-Schäuble Berlin-based juggernaut, which is crushing any chance that the French economy has of recovering?
Now, I have one final question for you, and I want to take a trip from France to Italy. Italy's Premier Enrico Letta, he's going to resign after losing a key vote, and now 39-year-old Matteo Renzi will become the youngest prime minister of Italy ever. What politically do you expect to happen in Italy regarding austerity and structural reform? We got 30 seconds. Can you give it to me fast?
We have a political system which is displaying all the signs of the malaise that are underpinned by an economy that is stuck in a rut with a credit banking system which is incapable of financing any prospect of recovering within the real economy.
So good times for Italy ahead is what you're saying. No, I'm joking. Yanis, thank you so much. That was political economist and author Yanis Varoufakis. Time now for today's big deal. Joining me now is well, he's not a doctor, but in my opinion, he is just Mr. Edward Harrison. And we're going to talk about the European continent's most western country,
Portugal.
Portugal. Now, official figures released at the end of 2013 show that property prices across Portugal have sunk to unprecedented levels, even below the bank estimates. Now, bank estimates, will typically value properties lower than their true market values to avoid risk and to help ensure that the properties will sell. Values usually vary from 1 to 20% less, and in a depressed economy such as Portugal's economy, these values can be even lower. Now, Ed, despite what we know about Portugal's economy, it seems like a great time to buy in Portugal, no?
Well, it all depends on whether you think things are going to go lower or not, because people are saying that it's stabilizing because the economy has somewhat stabilized. The Prime Minister's talking about actually, getting out of the bailout program and so forth.
Do you see that happening?
I think that it's a possibility. At the beginning of last year, I didn't think it could happen.
Right.
But after we saw the yields in the periphery drop like a stone, I think that it is possible, and they're going to try to go to market with some bonds, and if they can not only go to market with paper in the 1 to 2 year time frame, but further out, maybe 5 years, 10 years, then you're looking at a country that can leave the bailout.
Okay, there you go. Now, according to new analysis by the Portuguese government, housing prices in Portugal, they're stabilizing, and they're likely to remain that way for the next 1 to 2 years because of a sluggish economic recovery. Ed, can you explain to me how Portugal's sluggish economic recovery helps to stabilize housing prices in a country? To me, this seems totally backwards.
Yeah.
I would think, the exact opposite would happen.
And I agree. I think that, it's just the wording of it in terms of what they really mean to say is that the sluggish economy means that that house prices aren't going to rise the way that they're rising in Spain and Ireland. Spain and Ireland, that's where Portugal wants to go. They're the ones who are already free and clear. They're out of the bailout program, and they actually, in Ireland in particular, they're seeing their house prices rise. But given how bad things are in the real economy in Portugal, That's not going to happen.
Right.
The best you can hope for is a stabilization.
And that's the best we can hope for. But Portugal has said it plans to resume auction of its bonds in the first half of this year. And on January 15th, they started selling one-year bills at 0.869%. Now, that's the lowest rate since 2009. Ed, what does this say about the Portuguese economy and recovery relative to countries like Spain and Italy and Greece, even?
Well, from my perspective, it says more about the so-called, OMT, outright monetary transactions that the ECB is talking about. Basically, there's a backstop for all of the periphery debt, and people are using that in order to buy. If you're a Portuguese bank, you can pick up a lot of yield by buying into Portuguese government bonds, knowing that the ECB has a backstop there for Portugal. And as a result of that, that pretties up your balance sheet, and you get a nice yield pickup at the same time. So both of those things are factors that are positive.
Right.
And I think it has much more to do with those factors than it does actually with the real economy.
That's interesting. Now, the rate on the Portuguese 10-year, it dropped 30 basis points to 5.23%, and S&P removed the nation's rating from negative credit watch, which is where it's been since September. And S&P uses credit watch to indicate a substantial likelihood of it taking a rating action within the next 90 days. So it's going to call it garbage within 2 months,
Junk.
3 months. Now, how much weight does this new credit rating actually carry? Does it actually matter? And if so, how much?
Yeah,
because credit ratings, they're, in my opinion, boo.
Well, the credit rating agencies, they were completely, we saw when they were rating all of these subprime things, AAA, that eventually became junk, that they weren't really worth that much. And I think in particular with sovereign debt, it's even more so the case that it's really not a factor. The market moves ahead of where the credit rating agencies are. I mean, the credit rating agency comes later. Remember when we were talking to Kate Long a few weeks ago, she was talking about Puerto Rico. She was saying Puerto Rico is in dire straits. They should be rated junk. Guess what happened just after that? They were rated junk. But she was saying that, and the market was saying that before the rating.
What were they rated at the time?
They were rated BBB-, which is the lowest rung.
Yeah, low, but it's still better than junk. Ed, thank you as always. That's all the time we have for now, but you can see all segments featured in today's show on YouTube at youtube.com/boombustrt. We also love hearing from you, so please check out our Facebook page at facebook.com/boombustrt. You can also tweet at us at Aaron Aid, at Edward NH. From all of us here at Boom Bust, thanks for watching. See you next time. Bye-bye.